a multifamily property, 50, 100, 200 units. Why would I go Fannie Freddie versus CMBS?
Okay, that's a great question. The short answer is if you qualify for Fannie Freddie, you go Fannie Freddie, right? That's your starting point. You'll realize here that only multifamily qualifies. So if you've got a office building, if you've got, a retail strip center, a mall, you're not going to qualify for Fannie. They just don't do that, right? Even if you've got a mixed use, there's a nominal amount of retail that it can have, but I think the number is 25% or less of mixed of retail. But you really can only do multifamily on agency. So that's the first answer. The answer is if you've got a multifamily building, you try for Fannie. Rates are relatively the same. Drop longer to originate. LTVs are the same. You can do a step down prepay, which is a 5, 4, 3, 2, 1 or something of that nature. But that's really the answer. The answer is you always start with Fannie. If you can't get a Fannie loan for whatever reason, then you can look at CMBS, balance sheet, and so on. CMBS is great for people who want to sit on their money. There is no prepay penalty. There's no prepay option, rather, for CMBS, which means any CMBS loan you do, you essentially have to sit it through its life.
So okay, got it. You can't refi out
You
shorter.
can never sell it. I mean, you can never pay off the loan through its life. If you do a 10-year, that means you're sitting on this for 10 years, essentially not able to pay this off. So you really want to go into a property that is stable, that
Why would you ever want, like, as an investor? So you're saying that basically I would never get into a CMBS loan unless it's a perfect fit for me for the next minimum 5 years.
correct, because it does have advantages. It's quick
Yeah.
and it's creative. So if you got to close in 30 days, you can do it with CMBS. There's no other way for you to do it. So if that's the story you're given a contract, you got to close 30 days. You don't have too many options. You have hard money and you have CMBS essentially. The other reason why you would want to do it is because they can get creative. It's a vacant space. No bank's going to do a vacant space. They can say, okay, you lease it up at closing. We'll hold back some money. We'll hold back 3, 4 months, make sure that you're cash flowing, and then release it. And they go up to very high LTVs. They go to 80. Honestly, they go even higher. They do a second tranche where you'll get like a kind of a mezz piece by the same lender. They'll do a B and C pieces. You can get up to 90, 95%. Certain scenarios, yeah, especially when you're getting large. Think about $100 million loan. You may not want to bring extra 10% to the table. That's $10 million. You may want them to fund the $10 million, forget about investors, forget about all that stuff. And it's easy. And it's non-recourse, which means there's no personal guarantee. So these are all positive stuff. I'm gonna add that in, non-recourse. So it's really, none of these are right and wrong. I just want to point out, it's very subjective to scenario. Obviously, if there was a wrong one, it wouldn't exist as a product. So they're all good for certain circumstances. And it's really understanding what they are and knowing how to kind of maneuver between them.
Which loans here are assumable? Like, instead of assuming that all loans are assumable, is there an idea of what we can look at? Like, only CMBS loans are assumable, or any information you can share on that?
Yeah, good question. Assumable loans. So I just want to make sure everybody knows what assumable loans are. Assumable loans are loans that you can basically sell the property and sell the loan with it, just pass the loan to the new buyer. The positives of that are obviously you can offer a property with a loan on it. The buyer, if you have a great rate, you can pass on that great rate to the new buyer. It saves them money. It saves the new buyer money for having to originate a new loan, which is timely. It saves them uncertainty. Originating a new loan, you don't know where the appraisal is going to come in. Here, you've got the property with their loan. So that's the good of it. The bad side of assumable loans are, let's say you've got a 6% rate, and now the rate's 2 years down the road, you want to sell this property, the rate's 4%. Nobody's going to take a 6% rate, or it would be a very hard thing to take a 6% rate. You can today get a 4% rate. That's one reason. The other kind of issue is that you have to qualify. You can't just pass it all on to anyone. They have to underwrite the new person as well. Make sure that they qualified the same as the original borrower, and there are some fees associated. They typically charge like a 1% fee just because they can. So those are kind of like the downside, but typically only agency and CMBS are assumable. Your standard loans, and you can negotiate with banks. I mean, the bigger loans are definitely more negotiable. Essentially, it's these two that have assumability. Balance sheet are kind of the banks, like I mentioned before, that are lending off their own balance sheet. So those are the community banks. Those are the banks that you see that have ATM machines and tellers. Those are those banks. They're taking in money from you as depositors and putting it out as loans and have FDIC insured guarantees and all that stuff. Those are balance sheet banks. They make their own decisions. They have their own committees. They're not following, any governmental agency guidelines. They're not following, stock market, big hedge fund guidelines. They typically don't sell their loans. They sit on these loans through maturity. And that it's just a simple old boring banking business, right? They're getting in money on one end for close to free, right? You're giving them your money for close to free in return, in exchange for the promise that when you need your money, it'll be there to take out. The liquidity and the safekeeping is what they're giving you. They're not really, these days they're giving a higher return because they need cash. But essentially, there were many years, you all remember, when you were getting no money. They were just doing you the favor of holding your cash. You were doing them the favor of giving them free cash to go turn around and charge interest on. Old fashioned, they hold this through maturity. Typical terms that you're going to see, it's going to be a drop more expensive, a good point, roughly point and a half more than market. Your LTVs are lower than the other products. So in that case, it's negative, right? You're getting 70, 75 roughly, as opposed to 75, 80. Don't have an interest only option. It's not assumable. There are a lot of positives. So let's focus on those. All asset classes. All asset classes, just to clarify, in the case of balance sheet, does not mean that every bank will do all assets. There are banks who specialize, who have niches, right? So if you need to do, if you want a retail strip center, there are balance sheet banks that will do those, but only specific ones. They're regional typically. So let's put that down. A negative is regional. A negative is lower LTV, and there are more, and we'll get in the future. Positives. Let's talk about positives. Positives are negotiable. All right, and this is really important. They're negotiable, which means you're going to, if God forbid you run into a problem year 3 down the road, you got 3 years left, you can go to the bankers, sit down with them and say, hey, I've got an issue, I can't pay this, that, let's work out a deal. And you can do that because for this very same reason as everything else. This is literally sitting on their balance sheet. There are 5 guys or 3 guys on the board that make all decisions. There's no bosses. There's no big agencies that you got to go back, and there's no Goldman Sachs here. There are people to talk to. That's very important, very important, especially when you're in a kind of an interesting time real estate wise. You want to think about that before going into a deal. Do you want a lender who you can negotiate with to some extent? I mean, obviously they have a lot of leverage. They've got the loan, first position lien, they can foreclose. So you can't just say, hey, I'm not paying. But what you can do is say, here, I want to work out a different payment structure. I've got this issue. We lost a tenant. We're getting a new one in 3 months. They're going to be much better. But for 3 months, I want to lower my payments and pay it back, over the and you can do stuff like that. So that's really about relationship. It's a relationship thing.
And also, I guess that also plays into the idea of also how long you've been with that bank. Do you have any money with that bank? The more cash you have with them, the more
Absolutely. Of
flexible.
course, an important point. There are many banks we're hearing about from now that say, hey, we're not doing loans for new clients. We will continue doing loans for existing clients. If you've been banking with us, if you've been taking loans from us before, and we know you, you're in good standing. We know how you pay. We know you're good. And that kind of is the feeling that goes into balance sheet banks. It's kind of this human element. So important in many cases. They're also kind of can understand the areas where these products are much more boxed. There's a system. They understand the areas. If they're, I've had bankers say to me, hey, my cousin lives down the block, so I know the area, I know the block. I'll extend you credit, higher than what I would do elsewhere because I know it. That's something that you don't see in any of these other products. So it's a really key point as well. That's part of relationship, really. It's knowing the area. DSCRs are worse. 1.25 to 1.3 and higher, and loan sizes are typically mid-range, small. That means once you get above $10 million, they'll go from $500,000 to like 10 million. After that, you kind of start dropping out on which lenders have the capacity to tie up so much liquidity for so long. All right, that's pretty much it. Now,
just to recap, at least from what I'm hearing, and I think just to kind of point out some key things here. Number one, when you're dealing with smaller properties, like sub $2 million, you are probably going to end up larger majority of the time with the balance sheet loans, right? The DSCR loans, possibly hard money loans, but rarely are you going to be in the CNBs or agency Fannie Freddie, right? Like you're going to be in the those are the CNBs loans, and Fannie Freddie probably only start taking place when you're starting to touch maybe 5 million, right? Maybe slightly under that. Like if you really have good relationships with some banks, maybe they'll hook you, or with the people at the the CMBS agencies and stuff like that. Maybe you can get lucky and pull it off. Like I think we got a CMBS loan on Asbury, right? The larger the property, obviously you're gonna be rarely using hard money, and DSCR loans on much larger properties, obviously unless you have to, like the hard money side. If there's major issues or stuff like that, right? And DSCR loans, those are sort of like, I kind of, DSCR loans to me are sort of like your small 2 families, 3 families, 4 families, smaller mixed use properties, smaller properties in general, like you had mentioned, up to $2 million. Obviously, as you're getting to larger and larger deals, you're using CMBS and Fannie Freddie types of loans. The only thing I want to make sure that I guess we cover here to make sure everyone hears is like when I'm talking with a client, right? Like a seller, what is like maybe 2 or 3 things really fast, like 2 or 3 things to think about when I'm speaking with a seller that will give me the idea of probably how to educate myself and then my buyer where to go here. Like if I'm speaking with the seller, what is like maybe 1 or 2 or 3 things to keep in mind, obviously besides a price they tell me, right, David? Like besides price, which will help me dictate, what else do I need to be thinking about when I'm talking to a seller?
Number one is you want to understand, is it cash flowing? Because all of these other products require cash flow. This does not. So that will basically separate, does it cash flow? And that's important.
Basically, for quick numbers, like just rough numbers, not obviously that this is accurate 100% of the time. What you're saying is essentially, if the cap rate is north of 3 points roughly above the 5-year treasury, you're probably going to be in a place where you can use a larger majority of these loans, right? And anything below that, you might have to go hard money.
Right. If your cap rate is at market rate, meaning your cap rate is 6% and the banks are giving out money at 6%, that's not going to work for a bank. That doesn't cash flow enough. So that's a quick,
unless they put down more, or we can think
unless they put down a lot more.
Exactly, right? Like they're gonna have to come to the table with a lot more money so that it cash flows, right? So the LTV is low enough, right?
So that's a perfect, easy kind of metric. 3 points above. If the cap rate is 3 points or more above the current rates, you can go with a bank, most likely one of the options. If not, you've got to either put down more money or go bridge hard money.
That's a really good point to be thinking about, everyone. Like where your DSCR, you need to be thinking of like what would you say is like a really comfortable number? 1.3 probably right now? Comfortable?
1.3.
So basically thinking about
comfortable. Yeah.
Yeah, we're just about almost any asset class for the. I mean, we're excluding office here for a quick minute because that doesn't really count for right now. But let's just say just about any asset class, guys. If your DSCR ratio, which is your debt service coverage ratio, is below 1.3, which is what we talked about last week about how to calculate that, you will have to put down more money a vast majority of the time in order to wherever it meets that 1.3. So that's a good point.